Hi everybody, welcome to the Baguette Investor channel for a new video. Today we're going to talk about growth and value investing in sector. So as you know, in my journey in the financial markets, I'm discovering more and more way to cut and put into different boxes, stocks, bonds, and all that stuff. And I discovered the difference between value and growth and how you can use it to choose where to target your investment into the most efficient category. So, first, I'm going to talk about what's growth and what's value. Growth, what I understood, are companies that tend to grow very rapidly and that usually don't pay any dividends. And value companies are companies that don't really grow as much, that are already settled, and that usually pay a dividend. So, this is more complicated than that. There are some nuances that you could go into, but there is also very important thing, the sector that is related to value and to growth. Usually people see growth as tech and people see value as materials, energy, and financials, for example. My idea is that when should you stop investing into growth and start investing in value, and when should you stop, vice versa, when should you stop investing into value and invest in growth? Because there is a rotation. Depending on the time of the market, if you're a market timer or you try to be a market timer, there is a moment where it might be a very good idea to flip your investments. For that, we're going to take a look at some different ratios that I found and that are very interesting. So this is where the real fun begins. So to make you understand really well, we're now on my new screen in my new apartment, so you have a better view of what's happening. So this is the S&P 500. This is the SPY. This is the ETF to track the S&P 500. You can see we're in a bull market since the Great Recession with the financial crisis. Now you can have the SPY, the S&P 500, but only the growth companies. That's the S&P 500, but only the growth companies. Now you can have the SPY with only the value companies. This is the SPY with only the value companies. Hope I'm clear. You can clearly see, if you are familiar with technical analysis, you saw right away the difference between both of these charts. If I look at the S&P 500, I will compare it to the S&P with only growth stocks, and I will compare it to the S&P with only value stocks. And what you can see is absolutely clear is that since the Great Recession, growth stocks performed 781%, the S&P 500 as a whole performed 724%, and value performed 316%. If you want to be clear, you have to add dividends, because value stocks tend to give dividends, so it's more logical to add dividends. We're going to add dividends. Anyway, if you add dividends, growth, which is the one right there, is still the best performing, and value is still the worst performing. What does that say? Well, it says that growth performs better than value. And you might have the answer is that, of course, in growth S&P, you have the tech sector, which is the best sector since the Great Recession happened. And in value, you have the financial sector, which is the worst performing sector since the Great Recession. Now, some people say that with rising rates, with inflation, growth might be not as good as it might be in the future, not as good as it was, and that 10 years of a bull market for growth might lead to a change in market influx. This is where ratio comes into play. This is what I'm looking at. I'm going to remove this. You have the ratio between value and growth. When this value goes up, it means that value performs better than growth. You can see that from 2000 to 2007, which was the peak of the market during the previous to the Great Depression, value performed better than growth. And then from 2007 to today, you see that growth is outperforming value. Why is that? Well, during this period from 2000 to 2007, if you have seen the charts, I don't know, maybe you're not as old as the market like me and you just look at what's happened in the past, it was a time where commodities, energy, gas, petrol, material stocks like chemicals, minerals, stocks that extracted gold, financials, banks, insurance, financial institutions were performing really, really well, and tech was not performing as much. It was not really a sector that was trending. It was the right after the collapse of the 2000 market bubble in tech. So really what the place to be during this decade from 2000 to 2010 was value. And then from 2008, 9 to 2020, 21, the place to be was tech, because it was the great bull market for big tech companies that at the time was were small, but now have become giants. Netflix, Facebook, Google, Apple, Amazon, Cisco, etc., etc. You know the deal. The question is for people, when will this trend change? When will value become a more performing investment rather than tech? When will tech stop outperforming all the market and value stop performing the market? The answer is in this ratio. What I'm looking at is this ratio right there. You can see some people believed back right there that it was the bottom for this ratio and that now it was the end for tech. It was like Michael Burry saying short Tesla and short the overvalued tech companies. And other people thought, well, no, this is just the beginning of tech. It's going to keep outperforming all the market. This is like Cathie Wood, which is all in on technology and disruptive technology. What we're seeing in the market is that the market is going to tell us in the next weeks whether you should be investing into tech or whether you should be investing into value. So if you're looking at this, this is the answer for the question whether you should be investing into value. This is for the big tech, big capitalizations, but you can do that for all the company, all the other capitalizations. But this is mid caps growth. This is mid caps value. You can see that mid cap growth look much stronger. You can see this one has already made quite a high, all-time high, and this one is only making a new all-time high this week. I need to lower a little bit that was because I'm dividend adjusted. There you go. If you look only at price. If you look at small caps growth, you can see it's making new all-time highs. If you look at small caps value, you can see it's not making all-time highs. So I hope this thing that I found and that I'm working on is interesting to you. I'm sharing this with you. Look at the ratio between growth and value, and that will drive to where you should invest to have your stock holding performing the best. Now that you know this, you may have seen my previous videos where I talk about my bet on energy. I invested in some stocks on energy. I invested in Royal Dutch Shell. You can see my average price right there. I invested in Total Energy, which is the French big company. And I have some oil and gas companies like TRGP, which performed quite well and has its earnings tomorrow. I have Oasis Petroleum, which is one of the only that is performing quite nice. And I have CXO, which is a lithium mining company. This is one of all my gaining companies, and the other here are losing value company. I just got taken out of Energy Fuels. I'm a little sad because the setup was quite great. Anyway, my idea was that I was playing the rebound on support. We're gonna check this ratio again. We were here, we were right there. And I was like, this is going to keep moving up and we're going to see growth stopped going up and we're going to see value start to perform very well. What happened was not that. We were starting to see a breakdown of this ratio, which means growth keeps outperforming. And if we start to see this ratio creeping up, down and down and down, it means that tech keeps performing and energy just doesn't do anything like it did the past 10 years. If you look at the ratio between the energy sector, which is XLE, and the technology sector, you can see that if you put your money in 2009 into energy and you take it out now, you have been outperformed by an enormous way by big tech companies. And is it the moment to enter again on energy and hope that it will outperform tech? Of course, energy is now very undervalued compared to technology, but that can keep going for forever. It can keep going down and down and down. This is like there is no uptrend there. So I was anticipating a move up, and it just did not happen. So right now, I'm not rushing on energy stocks. I'm taking a break because technology is just much stronger right now. And that's it. If you look at XOPQQQ, which is the oil and gas exploration, compared to the technology index, you can see there is a clear resistance point right there, and we're being rejected constantly. And that does not look like a strong bullish trend. It looks like a range market. So maybe for quite some month, technology and energy stocks are going to keep performing the same. But my scenario of a new bull trend for energy stocks is not happening right now. So there is no, it is still possible because this can look like a great bottom pattern. So we still have time for this, but I'm no longer rushing into scanning energy stocks like I was. I scanned quite nice energy stocks like this one, and you can see that there has not been much strength in the past weeks. It's just not moving up. There is nobody buying this, and when nobody is buying something, it usually goes down afterwards because it loses interest. So, I'm taking out my eyes off value and especially oil and gas, and I put my eyes into technology because and everybody can say what they want. It remains one of the strongest trends out there. You can see this is a company from Sweden that is performing like crazy. It's electronic components growth. You can see the speed of the trend. I also have other big tech companies like Salesforce, which is making new all-time highs almost every single month. There is AVGO, semiconductor company from the US. There is Square Incorporation. There is Google. There is Apple. And I'm also looking more at mid and small caps because this is the most interesting, according to me. You have the most growth potential. You can see that this company has a very beautiful chart. So this is my idea of me turning my back on my oil and gas scenario. I didn't lose or make money on this. If you've not seen my performance on my stock investment, you can see that I'm still very bad at stocks. I'm still learning. This is why I'm taking small positions, low risk. I'm learning the process. I'm working on the long-term trading and not trying to make the most of this year. So if you find these videos interesting, please consider subscribing and leaving a like. I hope what I said today was interesting to you, that you think it's interesting for me to share what I learn. Thanks for watching. See you in the next videos. Hope you're learning something. Have a nice week and goodbye.